Hi, my name is Sukesh Pai, and I'm a wealth manager at Trillium Square Advisors. Today, we will talk about exchange fund. What is an exchange fund? This is not an ETF or an exchange traded fund. An exchange fund is a private, illiquid fund that provides instant diversification to a concentrated stock position without any immediate tax consequences. The exchange funds are offered by a select financial institutions for high net worth individuals. The individual exchanges their concentrated stock position to gain ownership interest in the fund. This exchange is done in a manner that does not trigger any sale of the stock position and hence has no adverse tax consequences. Now, let us look at whether it is relevant for a given investor. Individuals who own disproportionate amount of their employer stocks may benefit by using exchange fund. The fund itself invests in a small portion of its assets in real estate to qualify for the exchange advantage. The rest of the assets are invested in stocks of other companies that their other investors bought in for gaining diversification. When you exchange your concentrated stock for ownership interest in the fund, you end up owning a basket of stocks contributed by other investors into the fund. Thus, your investment gets the diversification that you're looking for. Now, let us consider the pros and cons of using exchange funds. What we like about the exchange fund is that it provides instant diversification for your concentrated stock position. Another thing to like about it is that the transaction generally has minimal tax consequences. However, on the downside, we don't like the fact that the fund is generally illiquid and the investor needs to hold the investment for a minimum of several years before they can cash out. If they cash out earlier, the investor gets paid, the investor gets back their concentrated stock instead of the interest in the diversified basket, defeating the purpose of investing in the first place. Additionally, there are fees and commissions to be paid that are non-trivial. Since the tax consequences are at redemption, it is somewhat of a guesswork on how the future tax policies may affect this investment. The investor is on the hook to keep track of the detailed records of the cost basis of the concentrated stocks held prior to the investment, as well as the cost basis of the basket they own, so that they can calculate the capital gains tax at exit. A subtle issue with this is that the investor may have acquired concentrated position in various tax lots. All that distinction of capital gains across those tax lots disappears on the basket as the cost basis is treated on a pro rata basis. Now, what are the other investment vehicles that are available that may compete with or substitute for an exchange fund? A good alternative to exchange fund may be to consider tax loss harvesting of your concentrated stock portfolio on a systematic basis. There are financial service providers who provide solutions to optimize the diversification process over a few years with minimal or zero tax costs. A distinct advantage with this strategy is that the asset remains liquid and accessible to the investor at all times. We will cover more details on this solution in a subsequent video. I hope this gives you a bird's eye view on the exchange fund. It is important to look at your unique situation and determine if the exchange fund is the right vehicle for you. If you have further questions, please reach out to us. Our goal at Trillium Square Advisors is to serve you by making your money work harder for you so you can pursue your dreams.